Right now, silver has this strange split personality. On your screen, the spot price looks calm enough to feel normal, but the moment you try to actually buy real silver, coins, rounds, bars, the price jumps. Premiums are exploding, delivery times get weird, and suddenly you're staring at a checkout total that doesn't match the quote you just saw. That's not a small glitch. That is what it looks like when paper silver starts drifting away from physical silver. If you want more simple, story-style updates like this that connect the dots without making your head spin, please hit like and subscribe. It takes 1 second, and it helps a lot because these market shifts don't get explained clearly in most places. And if you've ever felt confused by silver's up, but I can't buy it at that price, you're in the right video. Let's start with the most important idea, and I'll keep it simple. There isn't just one silver market. There are two. There's the paper market, where silver is traded as contracts and claims, fast, liquid, and huge. And then there's the physical market, where silver is traded as actual metal that must be minted, shipped, insured, verified, stored, and delivered. Most people think those two prices are always basically the same. They usually are close. But when stress builds, they separate. And the separation shows up as premiums. A premium is just the real-world add-on above spot. It covers minting costs, distribution, dealer costs, and supply pressure. In normal times, that premium is boring. But when demand spikes, supply tightens, or logistics jam up, premiums can expand fast. And the reason it matters is because premiums are the part of the market that paper pricing can fully control. Paper can print a number. Physical has to show up at your door. Now here's the story version of what's happening. Imagine two people trying to buy the same exact thing. One person buys silver exposure with a click, like a futures contract or a fund. The other person wants real bars or coins. The first person can buy instantly in huge size without worrying about shipping. The second person has to deal with availability, premiums, and time. When physical supply is comfortable, both people feel like they're in the same market. When physical supply gets tight, they suddenly realize that they are not. This is why you'll hear people say, the price is the price. And then you go check physical and you're like, no, it isn't. And if you're in the US, you've probably felt this firsthand. Spot might be one number, but American Silver Eagles, generic rounds, and bars can behave like they're in a different universe during hot periods. The gap between what the screen says and what the metal costs is the beginning of a paper versus physical split. Now, does a higher premium automatically mean the paper price is fake? Not necessarily. It means the paper price is a reference, not a guarantee that metal is plentiful at that price in every form and every location. Physical silver is not just silver. It's silver in specific sizes, specific purity, specific brands, and with specific delivery timing. When those real-world constraints tighten, premiums expand, even if spot doesn't move much. So why would premiums explode even when the paper price looks controlled? Because physical supply chains move slower than financial markets. Mints can only stamp so much. Refineries can only refine so much. Shipping and insurance and wholesale inventory aren't infinite. And when a lot of people try to move from paper comfort into physical certainty at the same time, the physical market can't instantly stretch to match it. Here's the next part most people miss. Physical tightness doesn't always show up first in the US retail coin market. Sometimes it shows up in big hubs, where demand is more directly linked to manufacturing and wholesale flows. And that's where Shanghai comes into the story. When silver trades higher in Shanghai than in Western pricing hubs, that is a loud hint that someone is willing to pay more right now for real access to metal in that region. People call it a Shanghai premium, and it can act like a magnet pulling metal east. A lot of viewers hear that and immediately say, arbitrage will fix it. Buy cheap here, sell high there. In theory, yes. In real life, that trade is full of friction. Metal must meet standards. It must move through approved channels. It must be financed and insured. It may face import rules, taxes, paperwork, and timing delays. And the bigger the stress, the more those frictions matter. So the gap can persist longer than people assume, especially if physical demand remains steady. And this is where the phrase paper price breaking away from physical starts to sound less dramatic and more mechanical. Because paper markets can absorb demand by creating contracts. Physical markets can only absorb demand by moving metal. If Shanghai keeps bidding higher, or if US premiums stay elevated, or if wholesale supply feels tight, then physical is essentially voting with money. It's saying, the real clearing price for real silver is higher than the screen implies. Now let's talk about the plumbing of the paper market for a minute, but in a way you can actually follow. Paper pricing is heavily influenced by futures contracts. Those contracts can be rolled forward, traded, hedged, and offset without any metal moving. Most of the time, that's fine, because the market is designed for hedging and liquidity, not for everyone to show up and demand bars. But under stress, the near-term delivery window becomes important. not because most people will take delivery, but because the possibility of delivery anchors confidence. When a market gets tight, it often starts whispering through spreads. In plain English, that means silver now can start acting more valuable than silver later. If the front month becomes unusually strong versus later months, it can signal urgency. It's the market's way of saying, we want real availability sooner, not promises. That's one of the moments where paper and physical can start to argue with each other. And if you're wondering why this can turn sudden, it's because paper markets move like a crowd. They're calm until the crowd notices the same thing at the same time. Then they move together. A physical premium can sit there for a while and be ignored. Then one day, a key price level breaks, or a spread tightens sharply, or a headline hits, and suddenly everyone cares about the same constraint. That's when repricing happens quickly. Another piece of the story is inventory. You'll hear people talk about COMEX inventories, LBMA flows, and vault movements. Inventories can move for many reasons, so this is not about hype. But direction and persistence matter. If deliverable categories trend down while demand feels firm, it suggests the cushion is thinner. And when the cushion is thinner, the physical market is less able to absorb waves of buying without raising the real-world price, meaning premiums. Then there are borrowing signals, sometimes called lease rates. You don't need to memorize any formulas here. Just remember this. When something is plentiful, borrowing it is easy and cheap. When something is scarce, borrowing can get more expensive or harder. If borrowing conditions tighten while premiums rise, that combination can reinforce the idea that real bars are getting harder to source quietly behind the scenes. Options can also pour gasoline on this. When silver approaches major strike levels, market makers hedge. And hedging can create forced buying during fast moves, which can push price further, which triggers more hedging. It's a chain reaction. You don't have to be an options trader to understand the outcome. Once certain levels are crossed, moves can accelerate quickly because the system itself starts chasing. ETFs add another layer. When big funds see inflows, they may need to source metal depending on how the vehicle is structured and how creations and redemptions work. When investors rush in or rush out, it can influence demand for wholesale bars and tighten or loosen conditions. Sometimes the paper headline is ETF inflows, but the physical implication can be more pressure on sourcing metal, which again can echo into premiums. Now, here's the part that makes people nervous: cash settlement. Most contracts in paper markets do not end with someone carrying home a bar. They're settled financially. That is normal. But during stress, markets sometimes protect themselves by making delivery less attractive or by leaning toward financial settlement. That doesn't always look like a dramatic default. Sometimes it looks like a widening gap between paper pricing and physical availability. In other words, paper remains a tradable number, while physical becomes a scarce product with its own price behavior. So when you hear paper is breaking away from physical, the most realistic version of that is not a Hollywood moment. It's a slow separation that becomes obvious in daily life. Spot stays one place. Premiums stay stubborn. Delivery times stretch. Certain products disappear. Dealers stop discounting. And buyers start saying, I don't care what the chart says. This is what it costs to get metal. Let me give you an example that makes this feel real. Imagine a manufacturer that needs silver for production. They don't get to pause just because pricing is inconvenient. If supply is tight, they pay up because the cost of stopping production can be worse than the cost of a higher input price. That kind of demand doesn't behave like an investor. It behaves like a necessity. And necessity demand is one of the most underrated forces in silver, especially with industrial uses like electronics and solar. Now add investors on top of that. When investors get anxious about inflation, debt, currency stability, or market volatility, some of them move toward physical metals for peace of mind. That combination, steady industrial pull plus a wave of investor buying, is exactly when physical markets can tighten faster than paper markets can honestly reflect. And that's when premiums can jump in a way that feels sudden. So what should you watch next if you trying to understand whether this is a temporary premium flare-up or a real separation phase? Watch how premiums behave when spot dips. That one detail tells you a lot. If spot drops but physical premiums don't fall much, it means sellers aren't responding to paper signals or buyers are still there regardless of price swings. That's a classic sign that physical conditions are tighter than the screen suggests. Also watch persistence. A one-day premium spike can be noise. A one-week premium spike can be a supply hiccup. A multi-week pattern, especially if it shows up in more than one place, starts to look like a structural issue. If Shanghai continues paying up while US premiums stay firm, that's two different physical worlds telling a similar story. And there is one more thing to watch that doesn't get enough attention: whether the market starts valuing now metal over later metal. When near-term urgency shows up consistently, it suggests the system is being asked to deliver more than it comfortably can. That is the kind of condition that can force repricing, not because someone wants drama, but because the real world is demanding different terms. Now, I want to be careful and grounded here. None of this is financial advice. A premium can come down. Supply can loosen. Demand can cool. Silver can be volatile and frustrating. But what you're seeing when premiums explode is still meaningful information. It's the physical market speaking in a language that paper can't fully silence. And here's the moment I promised I'd save for the end, because it's the simplest tell that separates a temporary premium from a real split. If you see paper price soften, but physical stays tight anyway, premiums stay elevated, availability doesn't improve, and the Shanghai gap remains noticeable, then the market is effectively telling you that the screen price is not clearing real supply. That's when the conversation shifts from normal premium to physical repricing pressure. So tomorrow and over the next few sessions, don't just watch the spot chart. Watch what happens when people try to actually source metal. Watch whether dealers restock quickly or stay thin. Watch whether premiums relax or refuse to budge. Watch whether the price gap in other hubs persists. Because the real story isn't whether silver is up 50 cents. The real story is whether physical silver is quietly becoming a different market than paper silver. Now I want to hear from you because your real-world experience is valuable data. In the comments, tell me what you're seeing in the US right now. Are premiums where you live coming down, staying stubborn, or moving higher? Are you seeing in stock everywhere, or more back orders and delays? And if you've been watching Shanghai pricing, do you think that gap is shrinking or getting more consistent? If this video helped you understand what's happening, please share it with one friend who follows markets but still thinks silver has one simple price. Sharing is one of the fastest ways to get the right people into the conversation before the headlines get loud. And if you want to follow up, where I break down the exact signals to track week by week, premiums, spreads, inventories, and what it usually means when they move together, tell me in the comments, because I'll make that next.